Hello, everybody. So today I'm making kind of a different video. I don't really have a structure for this video. But you might want to listen to it as a podcast because there's not much to see. But my point here is I want to comment on the rate hike, this Fed rate hike. We've had a series of failure in traditional finance, and we've talked a lot about the crypto bank failures, right? Like FTX, like Terra Luna. Like that was into the news, but I don't think people realize the sheer size of these failures in the traditional system. In my video on SVB, when I was covering SVB, I mentioned that failure of SVB was 20 times bigger than FTX, and FTX was the biggest failure in the history of crypto. And FTX was the biggest company in crypto. So you have the 16th biggest company, and you have a failure that's 20 times bigger. And I just want to point out, I remember talking in October about the UK pensions that had leveraged up, and that bailout was $79 billion. SVB, when you look at the balance sheet of the Fed, and it's increased by almost 300 billion. Of course, that increase is not only linked to SVB. There's been more, but that bailout of SVB is going to cost hundreds of billions of dollars. And Credit Suisse, I still haven't figured out if it's 100 or 150, but to the best of my understanding, it's $150 billion bailout. And when I see all of these bailouts happening, and to me it seems like the Fed is blind to this. I don't know. Like, is it because Jay Powell is not up for re-election anymore? I mean, at this point, I'm beginning to think Lael Brainard would have been a much better Fed chair. I mean, I've often thought that, actually. I think she would have been much better than him. He's breaking things. He's literally trying to break things. We all understand the backstop, right? The bank term funding program. We all understand what the backstop means, right? It's a way for him to keep raising interest rates while also saving the banks at the same time. It's both QT and QE for the banks, and only for the banks at the same time. He's doing QT for the banks, QE for the banks, and QT for everybody else. And it's just this QE for the banks. But even with that, right? I mean, this is clearly defined within banks, but companies that have a bunch of debt and whose destiny is linked to their debt, either the debt they invest or either the debt they issue, that's like a bunch of the S&P 500 within this situation who has debt and who this debt impacts them, right? And this bank term funding program is absolutely wonderful because it allows banks to pledge their bonds as collateral at par value. And to give you an example of this QE, it's as if, I mean, imagine I imagine most of us, interested in stocks. I imagine we have losses, right, from 2021. It's as if you were able to take these losses and go see the Fed, and the Fed lends you 100% of the full amount, right? So if you have a stock that's down, you bought a stock 100, it's worth 10 now. You go see the Fed, they lend you 100 on a stock that's down 90%, which I know many investors are actually, right, opened on me. I got really hurt by the Fed. There is this double standard here. There is this double standard of, like you can't pledge your assets. Like if you have an asset that's down 90%, you can't go see the Fed and borrow against it at 100%. That's QE. That's what was put in place for the banks. And so my view right now is that obviously, I mean, tech stocks, growth stocks, in my view, for my portfolio, they're going to perform so well is what I see, because they have very little debt, and they're already way down. And they have so little debt to no debt, right? Most of the stocks I cover on the channel actually have no debt. But the bigger question is what's going to happen next, right? There are still issues. customers still have an incentive to move money to one of the big four, Wells Fargo, JP Morgan, etc. They still have an incentive. We all saw that statement from Janet Yellen saying that really whether a bank in Oklahoma is safe is going to be depending on the judgment of the FDIC, the Treasury, and the Fed all together have to judge whether they should save that bank. It's a case-by-case basis. It's not a statement for everyone. Not every bank is going to be saved. They said it was a case-by-case basis, right? So that was one of the things. There's another issue. Not only do customers have an incentive to move on to the big four, but you also have customers that are going to have even more of an incentive right now to move to the neobanks. Like SoFi, for example, banks that pay you 4.5% interest because they're going to raise rates twice, they said. So if they keep raising rates, so they can raise rate 2 days, right, 25 basis points. If they raise rates in May again, right, imagine the strong incentive that people are going to have to move their funds to other banks that give actually strong interest, right? Most money center banks still give 0% on your savings account and your checking account, or near zero. Right? So I realize they have now a QE for banks through the BTF program. Anyways, it's a weird name anyways that they use for it. But for that bank terming program, they have this QE built in. But I just think more things are going to break. When I look at insurance companies, for example, like whether you're auto, life insurance, home insurance, these insurance companies, their business is what, right? They get the premium, and they put those premiums typically in treasuries or in bonds or in MBS until they need to pay out the premium, and they're going to earn money on those premiums. All of these insurance companies, they are loaded with MBS. If you go look at the balance sheets, they are loaded with all sorts of assets, that have lost their value. So that's why when I think about this, I'm like, we better hope there is no hurricane, no drought, no sudden increase. We better hope there's no natural catastrophe, because that could be an example of an insurance that fails too. Because all of a sudden they have to access those funds that have unrealized losses, those funds that have been lost. And so maybe instead of doing a bank term funding program, they would do an insurance term funding program. And then what if it's a company that has a lot of debt? Are they going to do a funding program, a distressed company funding program? Because this is the other issue. Companies refinance their debt all the time. Bigger companies like utilities, they have to roll over their debts every year, right? And imagine at the rate at which they're renewing that debt right now. So maybe they got debt like 6 years ago, 10 years ago, at a very low coupon, like a 2%, 1.5%. The other day I covered a video on AT&T. AT&T has bonds under 1%. And imagine that they roll over, they have to refinance them. And what do they get now? 6%? More than that? Imagine the cost of these companies. But that's not it. There's commercial real estate, right? Even though a lot of companies are pushing, in favor of return to office, that's not fully happening. What's going to happen to commercial real estate? Auto loans. I look at auto loans very closely as an investor in Tesla. And part of my thesis in Tesla is that electric cars, not just Teslas, by the way, all electric cars are going to be so compelling within the next few years that these cars are not going to retain that value. So what's going to happen to all of these companies that have done revenue financing? Student loans, that could be a crisis. We don't know what's going to happen with the student loan. Now, I personally believe it's going to be paused, for a decade plus, but I may be wrong on this. Maybe they're going to resume student loans. Anyways, I don't have any student loans, by the way. I'm not really. I mean, I'm very neutral on this issue. I'm just saying, I just don't think it's coming back. I just don't. But it's like, what if it's coming back? You're gonna have a lot of defaults on perhaps other items, because money is fungible, and so if you have to pay this debt, you may decide to not pay another debt. So, anyways, I'm very, very stoic about this. I think overall for growth investors and tech investors, to me this is a wonderful thing for us, like, because if you're gonna be in the earlier stage of your life, say, or like let's say you're under 45, let's say, and you're gonna be investing much more, like you're still in the investing phase. Like this is wonderful. Now, if you're like within 5 years of retirement, whenever that is, well, you may think this is not as good. Like to me, this is wonderful because we're still gonna get decent deals in the stock market before there is a major run up. So I'm fairly happy about that. But when I look at what's happening to the banks, I expect more downside in the banks now. Actually, I sold Schwab. Actually, and I was lucky to be up like 10% when I sold it, but I sold Schwab because it's clear to me that they're gonna keep raising interest rates. He says twice, right, today and in May. Who knows? Like it's not like he can trust it. Like he's saying he's keeping raising interest rates. So I don't know. So could you have a situation where whenever an industry fails, you're going to have some sort of a QE for that industry, just like you had for a bank picking program? So you had bank runs. They did the bank term funding program, right? So that's QE for the banks. You give your bond and you give it to the Fed. Are they going to have a funding program for insurance companies who are down on their bonds? And then are they going to have an insurance for quote unquote zombie companies who can't afford their new interest payments on their debt, right? Are they going to have bailouts for all sorts of the population as they keep raising rates, which is a mess, which is very complicated to do, and which, by the way, from a monetary standpoint, is exactly the same. You're creating new money supply. So from a monetary standpoint, that doesn't change anything. So are we going to have that, or are we going to have a situation, where they just drop rates really fast? And I happen to believe that it's the only way. They're going to have to drop rates really fast. Elon Musk said that today. Many more people have told the Fed, you got to drop rates now. And if they don't drop rates, we know they don't drop rates. We know they're not dropping them anytime soon right now. My guess is we're going to get more bailout, which is why I have made the first meme of my life is kind of my mix of financial culture and American culture a little bit now. And so this is the meme I did, which is, it started with UK pensions, major bailout, Silicon Valley, major bailout, not a bailout. They said it was not a bailout, but anyways, Credit Suisse, major bailout, and then what's next, right? Local governments, insurance companies, zombie companies, a lot of legacy auto with people returning their cars, commercial real estates. And then are we going to get back into a world where households are hurting and you're going to have to do stimulus checks, and maybe do something about the student loans too, and do a bigger cancellation? So everybody gets a bailout at the end of the day, because we as a society are not willing through the pain, as we saw for a banking crisis. Nobody's willing to go through the pain of that. And so, and it also begs the question, right? So the banks are able to pledge their treasuries, their bonds at the Fed at par. It always begs the question. It's like the government's picking winners and losers here. It's like why just the banks? It's maybe you're a retiree. Maybe you're in your 70s and you're way down on your bonds. So why can't you go see the Fed? Because you're way down on your bonds because the Fed raised interest rates. Why can't you go see the Fed and ask to redeem at par, right, those bonds that you bought back in 2020? You know what I mean? It's like at the end of the day, we all get what the Fed's trying to do. They're trying to both raise rates and not lose face, right? As well as give a bailout, which they don't call a bailout in the back, which is the same as quantitative easing in my view. And in my view, that's not going to work. And my thesis is still we're going to see a end in rate hikes, and they are going to pivot. That is my main thesis. I sleep very well at night with tech stocks, with growth stocks, and you may know that I don't own bonds. I've replaced bonds by Bitcoin in my portfolio. My portfolio, what would have been bonds for a person my age, is all Bitcoin. So to me, this is gold, right? To me, this is gold right now. But it's I hate it. I think it's a bad idea. I think they should have dropped rates. I think they are going to lose the fight against inflation, and they should have dropped rates. But it looks like we're going to have another 2 or 3 months of big headlines and big things to talk about, while this could have all been, disaster could have been somewhat avoided with lower interest rates and finding another solution. And quite frankly, allow me to be an optimist for a second. The solution to the issue of debt, the solution to the issue of this bloated financial system with money everywhere, the solution to that issue is innovation. That's the only solution to that issue. That's a society where innovative companies, growth companies, are able to put out so much goods, so much stuff, provide so many services, create so much new value, that we get to a point where the GDP growth is, 8%, 10%. I think that's entirely possible when we see all of the value creation that's being created by innovation. But all this is doing, all these rate hikes are doing is killing innovation, right? Killing the growth. The video I showed yesterday, there was a healthcare company, an American healthcare company who had an innovation for removing calcium plaque in arteries. And I was reading about the story of this company founded about 10 years ago. Shockwave was the name of that company. And we were talking about their entire journey to developing that product and, the value of that innovation capital. And when I think about that one product, for example, and all of the lives that it's going to save, right? All of these lives that it's going to save. It's value creation. It's economic creation, right? Innovation is going to create a lot of value for us, tremendous value. On this channel, I talk a lot about solar panels and Enphase. Imagine that. We're getting a world where energy is going to be so cheap. This is going to create a lot of growth. This is the way out of this, right? Actually, But anyways, it's like I said, this video has no aim. I hope you still give me a like, even though there is really, really no aim. I'm trying. This is more like a traditional YouTube video where there is no structure. I'm sorry about that, but I really don't have much time today, and I need to do a reaction. Thank you so much for watching. Please subscribe. Please like. Today, if you are a net buyer of stock, and if you are a growth investor, today is good news. Not investment advice, though. Just entertainment. Thank you, and have a great day.